answering chat things while you're trying to find that. I'm running today. I couldn't find the button to record, so fortunately Tony found it for me.
All right, let's see. How's that look?
Looks
You guys
great.
got something. All right, all right. Okay, well, I will, I guess, go ahead and dive into it. How much time do I have, by the way?
Till you're done.
Okay.
We'll probably get the hook out if you're much past about 8:45,
Yeah.
but
Okay. Okay. It's good to know. It's good to know. I always ask because I do, I do these in 30 minutes or I do these in 4 hours and everything in between. So
yeah,
we'll
we're
see how we do.
somewhere in
We'll see how
between
we
there.
do. Well, anyway, thanks for having me on. It's great to be here. I really enjoy doing this with real estate investors. I'm a real estate investor myself. But tonight we're going to dive into financing your own deals with private family banking systems. But first, I'm going to start and just show you a quote I heard once that I really enjoy, and it's just about how we learn, in the constant state of learning we're in, but learning is one thing, but changing those behaviors and changing what we do is a different thing. Acting on that. But so I heard this guy say one time, he said people change in 4 different seasons. He said either when they hurt enough that they have to, or when they see enough that they're inspired to, or when they learn enough that they want to, or when they receive enough that they're able to. So it's just always stuck with me, and it rings true in so many areas in our life. But so that's kind of what happened with me. I had spent 20 years in the photo industry. I still have my youth sporting events photography business, and it was just I wasn't ever going to get ahead, and I was like, I need to do something different. And so I was in debt, and I heard a podcast of a guy talking about um, how you could utilize this thing called infinite banking and get out of debt and at the same time build up cash. And I'm like, well, no, because the traditional approach is pay down debt, then save. We think linear. And so I called him. He taught me all about infinite banking. I start practicing it for several years, loved it. And so much now here I am, fast forward, and whatever, 8, 10 years later, doing it as a career. And I had done real estate investing. I still do it. And so that was one of the first things I got into was like every real estate investor needs to know about this because it's another tool in the toolbox. And we all aspire to finance our own deals or get enough free cash flow where we're buying our own properties, right? You want to buy your own properties eventually, that'd be nice. But that's not just what it's about. It's about so much more than that. So I love doing this. I want to challenge kind of the status quo thinking on what we do with money. I want to challenge us to think long range as we talk through this. Real estate investors we are a conundrum because we have the ability to think long range when it comes to passive income. We want to stack rental properties and we can think down the road what that's going to do for us. But we are on the other side, some of the most impatient people because we want this deal now. We want it done now. We want to get this done now. And so we have this shift. We're constantly trying to be in a hurry, but we also can think long range. So I encourage you tonight as we talk about this, think long range through it. I want to start off, there's a human behavior. I talk about a few of these tonight. The arrival syndrome, and it's that basically just that we already know all there is to know. You have arrived. And that's a dangerous place to be, I think. And so, and obviously you guys are all here to learn, and that's great. And you're constantly learning new things, and that's wonderful. So I just challenge that. But Nelson Nash says, when this thing infects us, we stop growing, we stop learning, and we rot. We turn off or tune out the ability to receive inspiration because we already know all there is to know. And if you understand what's really happening, like with our money and how our finances go, you'll know what to do. And I'll unpack this a little bit. So we have this need for generational thinking. I think it's a lot of that has gone away over the decades, over the past century even. And there's just this need for generational thinking. I'm going to show you how we can kind of re-engage that thinking. How do we benefit the next generation and the generation beyond that? Beyond just hand them a bunch of money, you know? There's a need for life insurance and estate planning. Certainly, if you guys are in real estate, you have your other businesses, estate planning, estate planning, estate planning. I mean, get it in order. I heard a estate planning attorney was talking a few weeks ago, and he said, you know, when a family member dies, the rest of the family, the three things tend to happen. They fight and they fight and they fight. If the estate plan isn't, you know, if it's not locked in, what to do with it. And so I think it's important. I think there's also a need for disability income protection for us. And that's important, I think, too. But just someone once asked me, he said, if you have a machine that's producing $100,000 a year, would you pay $2,500 a year to protect that machine? And I was like, oh yeah, definitely. He said, that's what, I mean, that's what you do with your life. With DI, you know, if you get hurt and can't work, and what do you do? And it's just a good safety net. I'm not here to talk about DI tonight, but and then we have the need for controlling the banking function in our lives, and that's what I'm going to talk about the rest of the time. Nelson Nash, I'll bring him up quite a bit. He says, if some authoritative power distributed all the money in the world equally among all the people in the world, within 10 years' time, 97% of the money would be back under control of 3% of the people. Well, why is that? Well, they understand money and how to get it to flow to and towards them instead of away from them. Okay. And so think about big picture. Who's really in control of your money in general right now these days in our society? We rack up credit cards, we've got mortgages, we've got loans, we've got car payments. You know, who controls that? The banks, right? We are indebted. We're a society that utilizes, we like leverage in real estate, but we also are chronically in debt as a society. I mean, you look up usdebtclock.org sometime. It's a scary, scary thing to see live rolling numbers of how much debt this country is in. So learning to control your money, it's the most profitable thing that you can do over a lifetime. And that's what we talk about, when the power of becoming your own banker and what that looks like in your own life. You know, there's another human behavior. It's called Willie Sutton's Law. He was actually a famous bank robber, if any of you have heard of him. And he was, I think a guy was a reporter or something, asked him a question one time. He's like, why did you continue to rob banks so much? And he had a very simple answer. He said, well, that's where they keep the money, you know, and that's where they keep the money. Well, yeah. And so Willie Sutton's Law basically says, you know, wherever wealth is accumulated, someone will try to steal it. You know, and we don't have to get political tonight, but who's the biggest thief in the world or in our country? We've alluded to it a little bit in your, you know, your talk, Jane, earlier, just kind of all the different things that are coming up and ways money is trying to get taken in and absorbed in government sectors and what have you. Okay, if you have your chat open, just drop it in there. I would usually say show of hands, but just drop it in there. Now or later, that's the words you're going to type. Just a quick poll. Would you rather pay taxes now, or would you rather pay taxes later? I know we would rather pay taxes never. That's all of our answers, but I'm just curious, just a general consensus. Would you rather pay taxes now or later? So just type it there in the chat. We want to later, defer, right? We'll defer taxes. I got two answers. That's okay. They're coming. Okay. Keep typing them in there. I'm going to keep going through this. Would you rather pay taxes now or later? I'll circle back to why I asked that. Where do we put our money? We put it in the banks, right? Do we ever ask what do banks do with our money? So I want to teach you real quick about this thing called fractional reserve banking. If you've never heard of it, sit up and pay attention here because it's fascinating and kind of scary at the same time. So pre 1992, the Fed had a rule for banks basically saying they had to have 12% on reserve. So money that was deposited, they had to keep 12% on reserve. And then 92, they reduced it down to 10. COVID happened and they came in and dropped that reserve to 0. And they have yet to raise it back up. Okay, what does that mean? Let me show you what that means. We hear it and we go, okay, that's cool. Banks have to keep some money on reserve, but nobody ever goes, well, what are they doing with the rest of it? You know, we don't usually think that far. Here's an example of what's going on. If you got 3 people, they deposit $1,000 each into the bank. 3,000 goes into the banking system. Okay, they're going to keep 10%, and then they're going to loan out the remainder of it to other people. So 2,700 of it gets loaned out. That 2,700 gets deposited into the banking system. And then that bank, let's say, keeps 10% on reserve. And then they have 2,400 they can loan out. And so that third set of people, they put their money in the banking system. Bank keeps 10%. And now what's happened? Yeah, $8,260 got deposited, but only $813 is actually physically sitting in the bank. The rest of it got loaned out. So it's all this phantom money out there. And so that's fractional reserve banking. It's the Fed says it's okay for banks to do. If we did it, we'd go to jail, of course. But so what happens if the banks run out of money? Anybody been around for some of those? You know, I'm not gonna show this video. If you've ever seen Mary Poppins, great whole scene about a bank run. You know, when someone says, "Oh, they're stealing our money," and then all of a sudden, and we remember a couple years ago, not yet, even a year ago, people were running to the banks and trying to get their money out because banks were collapsing, several in a row. And it was a bank run at banks back in 08 when that happened. The banks were shutting their doors. We don't have the money. It's not here. It does not exist. We've loaned it all out. So that's what happens. So, but isn't my money insured? We say, well, FDIC, okay. That's fine up to a point. However, I can't find a newer one yet, but this last report showed 9.5 trillion in insured deposits, 121 billion. Only 121 billion is in the FDIC fund. That means 9.4 trillion is uninsured. So they didn't even have enough. And during the Obama administration, he said, well, that's okay. We'll let them borrow from the US Treasury. But where's the US Treasury get their money? Well, they get it from the Federal Reserve. Where's the Federal Reserve get their money? Well, they print it. You know, and so it's like the Treasury is financing the Fed. The lender of last resort has its own lender of last resort. You know, and it's cyclical, and we don't understand very much of what's going on. There's also a game you can do this in. When you run out of money, you just write more. I played this game with my boys recently, and we ran out of money. We're like, okay, so we're on pieces of paper, we're writing it out. And that's what's happening in our monetary system right now. You know, money, hence we're trillions and trillions of dollars in debt. So how do we get out of that cycle? And I love this quote. It says, we can't solve problems by using the same kind of thinking we used when we created them. Okay, one more human behavior, Parkinson's law. It means work expands to meet the time envelope allowed. It's 3 parts. So the first part, work expands to meet the time envelope allowed. Let's think of like a contractor. You hire a contractor to remodel the bathroom, and you say you got a week to get it done. So he gets it done in a week. A month later, you have another house, you hire same contractor, same bathroom. You're like, you have a month to get it done, knowing he can get it done in a week. How long is he going to take? You give him a month, he's going to take a month. So that's what that means. Just work expands to meet the time envelope allowed. We tend to just, even though we could do things in a shorter time period in general. The second part is a luxury once enjoyed becomes a necessity. So a simple explanation of that is, when you got your first air-conditioned car, would you ever go out and knowingly buy one without AC again? No. Same thing. A luxury once enjoyed becomes a necessity. I was talking to someone the other day. This came up, and she's like, "Oh, I have she uses the remote start to heat up her car," and she's like, "I will never ever buy another car without remote start." You know, it is just that's it. Third part, expenses rise equal to income. And we do that. As we make more income, we raise our standard of living, and expenses rise with that. But I would challenge you, if Parkinson's law can be overcome, if you can overcome this kind of daily, you will win. You know, and this is another Nash quote where he says, Parkinson's law must be overcome daily. If you cannot do so, you're destined to become a slave. The good news is if you can whip Parkinson's law, you will win and you'll get ahead and you'll start advancing and you'll see that, I believe. We have to change the way we think. Final pop quiz. You don't have to answer this in the chat. This is not the final. Yeah, maybe it's the final one. You don't have to answer this, but I want you to think, would you make more money? I'll come back and answer this in a little while and talk about this in a little while. Would you make more money if you had $30,000? Would you make more money loaning it out at 6% amortized for 5 years, or putting in a CD at 4% for 5 years? Okay, think about it. You don't have to bust out the calculators. So would you make more money? Which one makes more money? All right, pause that. There's 3 types of people. There's the debtor. It's the most of us probably, where we want to finance something, for example. We'll pay it off over time, get back to 0. Let me see if I can get my little pointer here. We finance it, pay it off over time, get back to 0, finance something else, pay it off over time. Think of a car, you know, buy that next car, pay it off over time, get back to 0. So we're constantly resetting at 0. The saver does the opposite, says, I don't want to go into debt over it. I will save until I have enough, then I'll buy that car and reset, save, buy, and constantly resetting. What I want to show you tonight is how you can utilize this to become what I call the wealth creator, where you can create this financial velocity that can literally last for generations. And that's not fluff. Okay, I'll show you. Now you can put this in the chat. You think taxes go up or down in your lifetime? Okay. Will taxes go up or down in your lifetime? It's just an opinion, obviously. But I don't think it can go down right now. Okay. So, and I always ask people, just think about it. We think taxes will go, most of us think taxes are going to go up in our lifetime, okay? But what are we taught in traditional financial circles to do with classic retirement approach? We're taught to defer taxes, right? Let's get in a tax deferred situation. But if you think taxes are going up, why are you parking all your money in something that's going to be taxed later at an unknown future tax rate? We have no idea what it's going to be. So just think about it, or don't put all your eggs in one basket. You know, don't bet the whole farm, like Jane said, you know, and think about it. So I always ask people, I just challenge the thinking. Like, if you think taxes are going up in your lifetime, be careful about putting your money into qualified accounts that are restricted, penalized for using it early, and so on and so forth. Okay. So think about it. I'm going to come back to this answer now. How many of you out of the gate, 6% is more than 4? Duh. That's an easy math, right? I did that the very first time. Well, 6% is more than 4%, therefore I'll make more. But we got to ask ourselves, how is the money growing? So on the left, the 6% amortized, right? You're paying interest. Interest is getting paid on a lesser amount each time over 5 years. On the right, a CD compounds at 4%. So the compounding effect will outpace an amortized growth because they're growing different. Does that make sense? I'm not here to sell you CDs, don't worry. So just think about how, you know, always do the math, right? We do deals all the time. I'm constantly saying, like, we got to do the math. You got to do the math before you do the deal and make sure it makes sense for you. But same with how we make our money grow in other vehicles. How is it growing and why does it make sense to do this? Can my 4% compounding, uninterrupted compounding, outpace a 6%, maybe even an 8% growth rate on something else? And I want to show you how you can potentially do both in one vehicle, okay? So I'm going to just skim through this real quick. Other places people put money, right? You know, we build up stockpile. Some get into alternative sources, ways to make money, certainly real estate. And then what we're going to talk about the rest of the time is this alternate warehouse called infinite banking. Okay. The infinite banking concept was really coined by Nelson Nash. He put out this book. I'll show you a link at the end. You can get a copy of this. It's a good read. It's like 92 pages long. It's not a bad read. I got it right here, actually. So if you can see me, it's a thin read. I've read it a couple dozen times over the years, and I still, it's just a refresher. I'll try to read it once a year, just as I always catch stuff. I'm like, oh yeah, oh yeah, oh yeah. So what is it? IBC. What is not? It's not some financial hack. Okay, it's about taking control of the banking function in your life. It's the best place to warehouse your wealth. It has guarantees. It has safety. You have ready access to your money, and allows you to just take over that banking function. Okay, so the vehicle through which we show people how to do this is properly structured, dividend-paying whole life insurance from a mutual carrier. Okay, now let me break this down. I'm wordy about it because I'm particular about it. It is not your grandparents' old life insurance policy. It is structured different. It is not the life insurance policy that our favorite financial gurus like Ramsey and Orman rail against. Okay, it is structured different. So properly structured. It's structured a very specific way to get maximum growth inside your policy and the largest access along the way. Dividend paying from a mutual carrier. I say that because there's two types of insurance companies. There's stock-owned companies. It's interested for the stockholders. And then there's mutual carriers. Whereas a policyholder, you're basically one of the owners of the company, thus entitled to the profits which come in the form of dividends. So that's why I say dividend paying from a mutual carrier. And tonight's conversation is strictly about whole life insurance. I'm not talking about term insurance. I'm not talking about universal life of any kind. I'm going to talk strictly about whole life insurance tonight. Okay. This is not totally new. Life insurance, whole life insurance, has been around since the 1700s. It was started as the Corporation for Relief of Poor and Distressed Widows and Children of Presbyterian Ministers. I actually shortened that name. It actually got started because ministers were supported by the church throughout their life. And then when they would pass away, the family was all of a sudden left destitute because they didn't have any money anymore. And so they started this idea back then around that. Who has cash value whole life insurance? Fun fact, banks carry billions of dollars in cash value whole life insurance. They own billions of dollars in cash value whole life insurance on their key employees, executives, etc. It's a tier one asset for them. If you can look at their balance sheets and you'll see it's a tier one asset. A couple of these own more cash value whole life insurance than they do in real estate in these big buildings they got around the country. It's fascinating when you start looking around. And so you start perking up going, wait a minute, what are they up to? Companies, they know about it. They knew about it. As you start digging around and seeing who's used it historically, people we might have heard of. So like Walt Disney, he couldn't get enough of a loan to finish building a theme park based on a mouse out in California. Anybody ever heard of it? And so he actually used the cash value from his whole life policy to finish funding it. Ray Kroc, when he bought out the McDonald brothers, he had a couple of different whole life insurance policies. He used one to pay some key employees. He used the other to start a marketing campaign on his newest mascot, which looked like a clown. Oh, Ronald McDonald. So, hey, maybe Ronald wouldn't be here if he didn't have that life insurance policy. Who knows? So it's just kind of fun as you dig around and see what's gone on historically. Certain dignitaries, they knew about it. Interesting article came out on Biden when he had to disclose his finances a few years ago. Talks about how he owns 0 investment products and 6 whole life policies. Just kind of interesting. And you go, now, wait a minute. What's he up to? We don't know exactly, but no investments, 6 whole life policies. So it makes you think. All right. So we're taught all this common knowledge. It's the uncommon knowledge that we want to learn. What do other people know? What are they doing? And how and why? How is it working? So I'm going to break down this. Just go through here a bunch of benefits of utilizing infinite banking and why it works. Okay, and then after this, we'll start diving into a few different case studies. We'll see how we're doing on time. Okay, so I want you to think about how we change the flow of our money. Don't get caught up as we go through this about traditional thinking about, I can only do this if I have ... X amount of extra money. Okay, sometimes we can change the flow of our existing money and create opportunity. And I'll explain that in a couple of examples. Okay, I think the single greatest benefit of utilizing this is the fact that it grows uninterrupted. Your cash value inside of your policy grows uninterrupted throughout your entire life, even while you're using it elsewhere. So let me say that again. If I borrow against the cash value of my policy, however much, any number, the whole amount in the policy is growing year over year as if the money never left. There's just not another vehicle out there like that. Everything else is growing on what you left in there. Okay. And then you're going to pull this money out and make you money, right? In real estate. You're going to pull this money out, make you money, or make it save you money. Okay. It addresses some of your lost opportunity cost problems. There's income tax-free growth when utilized properly. I'll show you that. You can use it now throughout your entire life and even use it to supplement or be your retirement income on a tax-free basis later when utilized properly. I'll show you an example of that too. It is not an investment product. It is an asset. So it is safe from investment booms and busts. So we're not putting our money at risk. When you borrow against a policy, it's not tied to your credit, the carrier, you, probably me, because you told me you needed a loan, know about it, and that's it. They're unstructured loans. When you borrow against your policy, you get to dictate the loan terms. Am I going to take a day, a week, a month, a year, 10 years to pay that loan back? How much am I going to pay? At what rate? You get to decide. And I alluded to it a minute ago. It's a multitasking dollar. That money is doing a couple of things at once. It's growing here and making you money there. And then, of course, it is life insurance. So we have this generational wealth transfer at some point. So I'm going to kind of unpack this as we go through it. 5 rules of IBC. Take the long view. I've already talked about that. Think long range. Don't be afraid to capitalize when you see it, once you understand it. The question then becomes, well, how much more can I get in throughout your life? Don't steal the peas. That's a reference from the book. Basically, it means be an honest banker. You wouldn't steal from the bank, so don't steal from yourself once you are loaning money to yourself. Don't do business with banks, as you can replace the banking function in your life. Be your own bank. Set your family up, and rethink your thinking, okay? Let's dive into an example. This is a client of mine, and he lives in the Midwest, small college town, and he had been buying rental properties, small rental properties, and he has a day job, so he didn't need the rental income right now. He was just, as he made it, saved enough, he would go out and buy another rental. So he was stacking them up for retirement. And so when we first sat down and went through it, then the question became, well, if you're not, you're saving and buying another house, what if we change the flow of the money? Like I talked about a minute ago. What if we change the flow of that money, and instead of just sitting in a savings account, what if we start putting it through a policy? Just what does it look like? Okay, so that's what I'm going to break down for you here. This is a typical illustration. Don't get too scared of all the numbers, but basically, a policy has a lot of different components to it. So, and they get structured a lot of different ways. We'll structure something based on you and your situation. So when you look at this example, take a 0 off if it makes more sense to you, or add 2 more on the end if it makes sense to you. We'll look at you and your situation and come up with something that's appropriate for you with your goals and objectives. Okay, so he was going to put $36,000 a year through a policy, and then as he built up enough over the years, he would buy another property. He was buying it for 50 grand a pop down there, small little college houses, And so anyway, the first year is kind of the hardest year, as we say, because you can't get as much out as you put in. And then somewhere between years 2 and 4, the cash value begins growing more than you're putting in. And somewhere between years 6 to 10, depending on how we structure it, the cumulative cash value takes over the cumulative outlay. In other words, the cash value is more than you paid throughout your life. So I'll break this down. So we built out a spreadsheet for him, and just to show him the breakdown of this. Okay, so we're going to look at this column over here on the right a little bit, and this is his loan amount he could take against his policy year one, day one. So he put 36 in. He could turn around and pull 22 right back out. But he's not going to that year. He doesn't need to. So he's going to just let it build in there over that year. And then the next year, the second year, he's going to pay premiums. And then he's got enough the second year to pay. I'm going to get the pen here. All right, let's look at this. Here's your annual premiums, okay? And then this big arrow in the middle here, he had enough cash value built up, so he borrowed 50K out and went and bought another property. Now he's the bank, so to speak. So that property via rents is going to pay him back. He needs to pay that 50K back. So he set himself up with just a 4% 20-year loan amortized. That's $303 a month. So that's where that number came from. So he took 50 out. He took 50 out. He bought the house, and rents are going to start paying him back at $303 a month for that principal amount. Okay. All the while over here, he's still going to keep paying premiums. Does that make sense so far? Now, the second year, go back. The second year up here at the top. I'm sorry, the third year. So this is the one he just did. The third year, he's not going to do anything. He didn't have he's got 40. He could go out and do something for 40, but he's going to let it sit in there and skip 1 year. Now, year 4, he has enough in there. So he's going to pull 50 out. And he actually has 22 left sitting in there. He could utilize for something else if he wants to. But he pulls this 50 out, sets himself up with a second payment just like the first one. And he could change these numbers down the road. It's up to him. We were just coming up with an outlay just to show him what it can do. So he's going to set up a second 4% 20-year loan, $303 a month. So that's why you see the payments here jump from $303 to $606. But now, instead of skipping a year, he's already got enough. There's enough growth momentum happening now inside the policy because they have a guaranteed growth component and they have dividends that are paying back into the policy. So it's growing, growing, growing. So that by year 5, he could do it. He did it this year, and now he doesn't have to skip a year. So he did it again. So this is property 3. Now his payments are up to $909 because each property is paying its own principal back. Year 6, he can do it. Year 7, he can do it. Year 8, he can do it. Now, every single year, look what's happened, though. He's put 36 in. He's pulling 50 out every time. And he's still got some left. These years. And that number's getting a little bit bigger each year. So we did this. We played it out 10 years. So up here at the top, we went 10 years. He could keep doing it, Did it again. Now his monthly payments between all the properties are $27 a month. So he's paying that back. And then this column over here is his cash value growing. This is showing monthly. That he can utilize at any time for something else. All right. Now, the way we structure policies is different for everybody. Some people will pay the higher premium, like in his case, 36. We did it for 10 years. And then we're dropping it down to what's called the base premium, which is only $12,000. So that's why you see his premiums drop here to here, $12,000. And he'll continue to pay 12 now for a while. But because we've got enough growth. Some people, we only do this for 5 years and then we drop premiums. Some younger ones, they have more time, so we can put more in longer. Maybe we'll do it 15 or 20 years. It just depends. So now we just said, okay, well, let's stop buying properties and let's see what happens. So the policy cash value is still growing year over year because he's still paying premiums and he's recapturing all of these, the loan amounts. And so this cash value over here is growing year over year over year over year. And again, any day he can walk in here and take a loan against his policy. You know, he can go out and buy a couple more or buy a bigger one, whatever he wants to do. If his car breaks down, instead of going to the bank, he can borrow here, go pay cash for the car, and then set himself up with a monthly payment plan like he would have done with the bank anyway. So now you start replacing the banking function in different areas in your life as you're building up cash value. Okay, so let me show you something. This takes him 17 years in now. He's got a gross 561,000 minus the loan amount. So he has a net 351 down here he can be using for something else. But look what's happened. He's now got so much momentum going, the compounding growth inside of his policy. He paid 12,000 in premiums that 1 year, and his cash value grew 36,000 or so. Above and beyond that, he recaptured a year's worth of monthly payments. So the available cash value jumped to 52K that year. Okay, so say it again. He paid that year, he had so much compounding going on in his policy. He paid 12,000 in premiums and it grew 36,000 in cash value. Plus you're recapturing all of the principal amounts you've been borrowing out. And that's just a great tool. And now, I mean, you can cycle this over and over and over and over again throughout your life. 20 years in, he's got 660,000, you know. Okay, so that's just one example. Any quick questions on that? If you want to type them in the chat. I'm going to do a whole nother longer case study. Okay, let's go on. This one, I'm just going to take you through, I call it the life cycle of a real estate investor, you know. So I realize there's different laws out there on wholesaling, but this guy's getting into wholesaling. He doesn't live in Illinois. He's going to get into wholesaling. So he wanted to become his own bank, finance his own deals. He wanted to have a way to fund retirement as well, plus generational legacy. So his policy, he was going to do 25 a year, sorry. He was a 30-year-old guy, so he had more time. So he was going to do it for a longer time period. You can see those in premiums over here. We're not going to break this down too much. I'll show you in a different graph here. But so this is the same numbers, but in graph form. Okay. So here's what we want to look at. Remember, in his case, so the yellow line is his cumulative outlay in premiums throughout his entire life. And the purple right below it is the cumulative cash value that particular year. So those are the two numbers we're going to worry about. So again, so here, year one is the greatest loss of access, but if he put 25 in, he has 18 accessible right away. Okay, year two, he put 25 in, so that's 50 total. He's got total 43 accessible. Year three, another 25 in, 68 accessible. Now, a lot of people go, no, wait. I'm 3 years in, I got 75 in and only 68 available. That's not a good return on my money. A couple of things. One, it's not an investment product. Two, it is compounding throughout your life. Watch, from years 2 to 3, his cash value is 43,000 and change. He put 25 in. It's already growing more than 25. Okay, so he's just starting to now it's going to start making up for those first 2 years loss of access. And every year thereafter. Year 7 for him, it tips. He's got a cumulative 175 in, 177 accessible. Okay, and it's just now, it's just made up for those first couple years. But by that third year, it was already growing more than 25 and larger every single year. You know, take this guy into retirement. By 65, he will have paid 560,000 in premiums throughout his entire life, and will have been utilizing the cash value throughout his entire life to make him money, and he will have built up 1.4 million in cash value. Okay. Same numbers, same illustration. Okay. So how's that play out? Here's just one example. Okay. First year, he paid 25,000 in premiums. He had 18 accessible, so he's going to take it out, use it for marketing, earnest money, wholesaling. Say he set a goal for wholesales modest. He was going to make 45 or so that year. I never met a person got into wholesaling and quit their day job. So he's got a day job, their first year. So for wholesales, now he's going to take that money. He's going to pay the loan back. He's going to pay the second year's premium. And then he's got like 43 accessible. So he's going to double down, borrow, do double the amount of wholesales. Maybe he pulls in 80 that year, pay back the loan again, pay back the next year's premium, and he's off to the races. Okay. Just to kind of get your head loosely wrapped around how that can work. But let's take him now a few years in. Now he's got enough to maybe start financing the rehab part of a fix and flip. Okay. So fix and flips, what's that look like? Couple years in, same guy, same numbers. He's got 68 available year 3. So now he doesn't need to get hard money for the construction side, maybe. And over those years, he can be doing fix and flips. It's growing and growing and growing. And he can take the profits and pay premiums. He can loan his own money to his real estate business and charge his real estate investment business the interest it's going to cost him, which I'll talk about. Let me show you how that looks. All right, so I used to use this when I would do flips just to calculate the deal. So the deal is a 250 purchase. You see down there in the gray box, 250 purchase, 35 ARV. I'm sorry, rehab, 350 ARV, 3-month hold. Okay, that's all these numbers here. All right, so he's going to go out and do hard money at 12 and 4, 10 and 2 for the construction and get the whole amount. That kind of deal would get him about 19.8 in profit. Okay. Maybe modest starter, fix and flip, whatever. Using hard money and private money. So what's it look like instead of the 10 and 2, he borrowed against his own policy. So you see down here at the bottom, he jumped from 19 something, what did I say, 19.8? 19.8 to 21.5. Plus, that particular year, his cash value grew 3,600. Okay. So what happens if people say, well, I can do cash, I'll make way more money? That's true, you will. So consider lost opportunity cost, pay cash for the whole deal. Your profit's going to jump 39K from 19. That's a big jump. But this is your taxable gain, right? This is your taxable profit. So what happens if you did the whole amount through your policy? Down, same number down here. Your profit's a little bit, your net down here is a little bit less. Now that circle stayed. Let's see if I can undo that. And well, anyway, we'll leave it there. But anyway, so he had 35 here, plus that 3,600 or so gain that particular year. So his true profit was about this. However, this is his taxable burden. So he reduced his taxable burden by using money from the policy, because he's going to loan himself the money and he's going to charge interest on him. You see over here, he did 5%. And so they'll write off that 5% from himself. He loaned himself the money. Plus, it's an unstructured loan because you are the bank now. So you get to dictate when is that loan going to get paid back. Maybe you don't pay anything until the deal's done. There's no need. The deal's done, then you pay the loan back. And the cash value is growing. If it takes you 3 months, how many of you have done a rehab and you open up that wall and whatever was behind that wall just tacked on another 30, 60 days to your project? You know who doesn't care is the lender. he doesn't. He still wants to get paid. It's like, you got to keep paying. You got to keep paying. And if you are your own bank, go for it. Yeah, Jane.
I got a couple of questions. I I've got one that's in the chat that I'll ask first. Are the loans interest only or principal and interest payments? And this was asked when you did the first example.
Yep.
I think you
So
can set it, right? It's
yeah,
your
so
decision.
you would do principal payments. And I'll talk about that in a minute. I'll talk a little bit more detail how the interest works.
Okay, the other question I've got is when the life insurance policy is the one that's collecting the interest, are you still paying taxes on it currently, or how does that work out
Paying
tax?
taxes on what?
Like the 5% that's getting paid
Um,
to the paid to you,
no,
the lender,
no.
or
I mean,
your house?
you want to talk to your accountant how to, because everybody's got different business entity structures and how you're going to do it. So one way people will do it is I own the policy. I'm going to loan my LLC the money for the deal, and I'm going to charge my LLC an interest rate. At minimum, I'm going to charge them the interest rate it's going to cost me.
Okay,
So instead of it just if I took the same amount, if I took $50,000 out of my policy and I went and bought groceries and concert tickets, whatever, there's nothing I could do. It's the interest is going to cost me
yeah,
from the carrier. Now here I loaned it to my real estate investment business. Now they have an interest expense, so they're going to deduct that 5% interest. So now,
I guess what I'm getting at is there any reason you aren't charging 10% and 2 points?
yeah, you can charge yourself 10%, 15%, and it will write off that 10 or 15%. But now the technicality is you have just made an income of 10, the difference.
Okay,
And so that's where you got to talk to your accountant. It doesn't even make sense. If you have a single member LLC, it does not make sense because it's all a pass through anyway. You're not gaining anything. You're gonna pay taxes here, you're gonna pay taxes there.
okay.
You know, it just
So it
depends.
it is taxed is what the bottom line is here.
The
Thank you.
gain, if you charge above and beyond, it's technically income, but that's between you and your accountant. I mean,
Okay.
okay. So I will go break down the interesting a little bit as we go. But anyway, so the point being, you can reduce your taxable burden this way also. Plus, you've got the unstructured loan and so on and so forth. Okay. And now let's move on. A few years after doing fix and flips, he's ready to get into buy and holds, and he's built up a couple 100,000 now. So he gets 8 years in over here, and now you got 200,000 in here. Well, you can go buy. Let me ask you questions. You could, if you're quick typing, I'm not going to camp there. If you had 200,000, did you put a down payment on 4 houses or cash for 1 house? Oh, say 4. We like leverage, right? So say buy 4 houses with it. Put a down payment on 4 houses. Okay, so I put this is an old one. Anyway, yeah, you can get them. Anyway, so you can go out and put a down payment on 4 houses. We ran some typical numbers for M&R and insurance and stuff. And so he's got the 50,000 policy loan on 4 houses and financed the rest. So you got a good deal at 6%. It's all over the board. So I quit trying to change it every week. And what happens is now your rental income, you want it to pay back that principal loan you took, but it also needs to pay the mortgage. So do the math, make sure it works. Okay. But over that 10-year, let's say he set himself up with it's a 10-year mortgage with himself. So he's going to pay that 50,000 back over 10 years. Over 10 years, the cash value in the policy will still grow a net 148,000 for him. So let me break that down. Here, the first year, we pulled $200,000 out and went and bought houses with it. He kept paying premiums, but the net growth over a 10-year period, if he were to pay that $200,000 back at the end of year 10, he would have 586,000 in here. If he didn't, he would still have 386,000 in here. He would have that same growth minus the principal he still has out. Does that make sense? So it grew as if you never pulled the principal amount out. Okay, and that's a big deal. because that's an extra $148,000 you can use for something else along the way. You don't have to wait 10 years. You can use it as soon as there's money in here. You see the second year, he'll have 239 minus the 200, so 39,000 in there. Plus whatever he's paying back on the loan. And this is a net growth. This is factoring in cost of insurance over here. So this is net after that. So it's just a fantastic growth tool. So not only did he have the 148,000 net growth, he had all the rental income plus the home equity growth. You know, could you use the extra $148,000? You know, you could do a lot over a lifetime. There's a question about age. And I get asked a lot, am I too old to start this? Or when's too old to start this? So, I have people in their 70s that have started policies, but here's the thing, usually it's cost prohibitive because of age. However, you can get policies on someone that has insurable interest to you. So you can insure your children, your grandchildren, you can insure business partners, things like this. So we would explore who those could be and what that looks like, and if that's a possibility. And then you own the policy. So let's say you're in your 70s, you can't start it on yourself. Let's say you're uninsurable, even forget age. Let's say you're just uninsurable. You own the policy on someone else who has insurable interest. As the policy owner, you get to control the cash value while you're the policy owner. You can hand ownership of that policy over to them at some point. So it happens all the time. Kids are the most common. You know, I've got policies on my kids. They're only 7 and 8. I'll control the cash value now, you know, and use it along the way. And at some point, they'll be able to use it. And I'll teach them how to use it. Okay. So I've been using the term borrow against your policy. We're going to talk about the interest here a little bit too. Borrow against your policy, not borrow from your policy. So what's happening is you, and then there's the insurance carrier, and then the private family bank is your cash value. Okay. So you call the carrier, you say, well, how much cash value can I borrow against? They're going to look at your policy and say, okay, you can borrow X amount. And then what they're going to, you say, okay, great, give it to me. So what they're going to do is they're going to loan you their money, all the while your money will sit and grow uninterrupted. So behind the scenes, that's basically what's happening. And a lot of people gawk at the fact, oh, well, I'm getting charged interest. It seems like it's on my own money. I'm getting charged interest to spend my own money. But that's not really the case because they're loaning you their money so your money can grow uninterrupted. And remember, we talked about earlier how compounding can outpace cost, like an amortized cost. This is not an amortized loan. I put 4% on here, so they have fixed and one carrier we use the most has a fixed and a variable loan rate option. Right now, the fixed rate is 4%, which means anybody who gets policies, particularly right now, is still 4% this year on most of these products. Through the whole rest of their life, as long as they have that policy, they can borrow against their policy at 4% fixed. They can choose variable. Variable is up in the low 6s right now. So you don't want to do that right now. But that means now, during COVID, nobody cared. You know, they were like, oh, I can get free loans right now. But now everybody's like, oh, sweet, I can borrow at 4% anytime the rest of my life. Like, yeah, you've locked in that 4% rate from your policy. So that 4% cost, while the whole amount is compounding, my compounding growth will far outpace that loan cost over time. And then it's an unstructured loan. So you'll pay the principal back however you want to. The interest that accrues, they're going to send you a bill once a year for the interest that's accrued that year. It's simple interest. So they're going to send you a bill once a year for that interest. Now, even that bill is optional to pay, meaning if I don't pay it, they simply make it part of the loan the next year. And then you're compounding kind of against you. So I always tell people, hey, if you can at least pay the interest, pay the interest. You know, sometimes, so I've got a larger policy I had started to buy some commercial property. And I have taken max loans out every year, and I haven't paid any of the interest back because I have a liquidation event down the road, and I'm making more money with it staying out than I am worried about the interest, if that makes sense. So I don't worry. I'm letting it compound because it staying out, doing its job is making me more money than me trying to get money paid back in here. So I'm leaving it out because I know I have a liquidation event down the road that's going to backfill that loan anyway. So there's times like that where it may make sense just to let it compound. But generally speaking, if you can pay it, pay it. Makes sense? Okay. What about a trust? We talked about who can own the policy. A trust can own a policy, certainly. There's a few more hoops to jump. Mostly what you want to do is make the beneficiary a trust at some point too. That's a conversation I'll kind of cover right at the end. But certainly a trust can own a policy. When you fund your policy, I've been showing you annualized examples. Most pay monthly, right? Most don't have chunks of money sitting around. So effectively, once you pay it in, day 2, you can borrow against your policy. So these examples, this guy doing 25 a year, he paid 25 in day 1. Basically, day 2, he could borrow that 18 right back out if he wanted to. Now, I say day 2, there's processing times and all this, so you're probably 2 weeks realistically from the start of your policy. But it's not like some carriers, you got to wait a year or 6 months or 3 months. Sometimes they have these holding periods. We don't. The carriers we work with don't do that. There's no holding period, so you can get access to it right away. Okay, let's keep moving on. He's done buy and holds. Now he's going to upgrade. He's ready. He's got $500,000 built up in here. He's going to get into a commercial deal. So I want to show you actually an actual example. And this is another example of changing the flow of money. Okay. And again, don't get caught up on the number of zeros. This just shows you possibilities. If you're into commercial real estate, you'll love this, I think. And so anyway, he's got $500,000 built up. I'm going to pivot and use a real live example. So Stan Bullis, who owns Unbridled Companies, heard about infinite banking, and he had bought this Grant Street mansion downtown Denver and did this massive historic renovation on it and converted it to rent office space to his companies. And so he heard about infinite banking and was like, well, I wonder what it would look like to run my mortgage through a policy instead of directly to the bank. Okay. So he was paying he's a $400,000 a year mortgage. And so we said, okay, let's run it through the policy. Now, this is a year 1 example. So he put money in, he can only get 260 out. Remember, year 1 is just not, that's your greatest loss of access. So I only showed you year 1. But that means he was short. He put 400 through the policy and he could get 260 out, but he was short 140. So that means he needed to come up with 540,000 total, which he addressed by that's what rents were in a year from the companies that were renting the building. So rents in effect are paying 540,000 a year. And that funded his first year. Now every year thereafter, that spread is smaller. So he doesn't need to, you know what I mean? He's not putting $540,000 a year to the bank in the policy, if that makes sense. Because his cash value will be larger each year. Anyway, $400,000 a year mortgage, pass through instead first through a policy and taking max loans out to pay the bank. He had a 15-year mortgage. And so why does that matter? Here's these numbers for his policy. This is actually on his wife. Let me see if I can mark this here. That was year 1, year 2, year 3, 15 years in. He's only paid 4.5 into the policy. He's got 6.5. He will have borrowed. It'll pay the building off probably by then. And then he's going to reduce premiums. Remember, we did that for the other 2. We start reducing premiums over some period of time. The savings in the premium reduction, instead of just spending it, Parkinson's law, instead of just spending it, he start taking that savings and paying the policy loan back. So fast forward, think long range. You don't buy a big commercial building like this and think about tomorrow necessarily. You're thinking down what's this doing in the long run. But even this is 15 years in, even 30 years in, fully funded, he will have only paid 6.1 in premiums throughout his entire life and will have 15.7 million built up on top of this whopping $24.8 million death benefit. And so that company's going to be okay. That what company could use an extra 15 million? Can you do some business growth with that, over time? And then if she passes away, $24 million goes to that company. So it's just a phenomenal way, for larger projects, larger deals, syndications. It's possible to do it with syndications, even and we have cross sell, buy sell arrangements, and lots of unique situations for syndications. But there's a lot more money that can go in and pass through policies. So what happens after that? Yeah, Jane.
Could you go back to that? Yeah, go back to that chart. I'm looking at it and going, okay, you put 400,000 in, his death benefit that first year is 10 million or 8 million, whatever.
Yep.
Wouldn't he be better off just getting a second policy?
For what?
Or, I mean, his death benefit then it'd be 16 million for only having put 800,000 in the second year, and it'd be
Well, you've got to keep, you can't
24.
just do a single premium fund. He had to keep paying premiums of some form.
Okay,
Um, and rather than just start a bunch of 1-year policies,
okay,
you would have nominal growth. There's ways to structure that, but it's not efficient, you know.
okay.
And our objective through the lens of infinite banking is, what is the cash value doing? You know, versus our primary objective being how much death benefit can we buy? If
Okay.
we get 8 million here, but they really need 16 million in coverage, we'll
Mhm.
buy more insurance within the policy or get a second small term policy if it's just about death benefit.
Okay. Okay, it just looked to me like the death benefit isn't growing
Mm-hmm. Mm-hmm.
anywhere near as fast as that first initial kick is with it. But
Right. That's right. That's right. Yeah,
okay,
because of the way we structure them, um, because we're designing them for more cash value access, which isn't buying as much death benefit.
okay,
It is giving you more access to cash value. And so because it is life insurance, though, we do have that conversation. How much is appropriate? How much coverage is appropriate, and kind of go that route.
okay.
Okay.
Thank you.
Okay. So this guy's been using this policy throughout his entire life. It's been making him money along the way. And now he's ready to hit retirement. So you'll see by age 65, his premiums are 590 total throughout his entire life. He's got 1.4 million built up. By 70, here at 65, we stop funding the policy. We don't need to pay any more premiums. That's just the year we picked. We can do this at any age, really. But so you'll see over this 5-year period, he doesn't pay any premiums. And how much did his cash value grow? Grew some 300,000. So now I paid nothing and I got $300,000 in cash value growth. I go up to 80, I paid nothing. I went from 1.7 to 2.7 over a 10-year period. $1 million in cash value growth over a 10-year period for having paid no more premiums. Okay. But what are we going to do with that? Plus the death benefit, which we haven't even really talked about. Okay. So what are we going to do with that? So he's 70. He's got $1.7 million built up in cash value. We've stopped funding the policy. We stopped it at 70. So let me show you this here. This is the illustration side, the same numbers. He paid 590, 1.7 built up. And now we stopped funding it. And he's going to start taking a loan against the policy for retirement, income tax free at $100,000 a year. Why is it income tax free? Because it's a loan and the IRS does not tax on loans. Okay. What happens is any money you borrow, if you pass away, they will deduct that amount owed and the interest from the death benefit and pay the difference to the beneficiary. So the numbers on the far right is the net death benefit that would pay out that particular year if this person passed away that particular year. But we are also borrowing, so we're, as we're borrowing more, you see that available death benefit dropping because you're collateralizing it basically. And that's fine. Some people, so like I have a policy, its sole purpose, I use it now, but its sole purpose at the end is not going to be for death benefit, it's strictly for retirement. So I have other policies that are for death benefit, if that makes sense. Because I have that one that's set up and that's my retirement plan. So anyway, this guy, $100,000 a year for retirement, income tax free. He can do this for 20 years. We'll go down here. He can do this for 20 years. He will have pulled out $2 million, only paid $590. And if he were to pass away this year at age 90 for him, it would still pay 1.4 million out to the beneficiary. So he had this one policy. He started $25K a year. He was using it along the way to make him money, save him money. And then he got to use it to supplement or be his retirement, income tax free because he took loans. You can actually withdraw up to the basis and then switch it over to loans, but took loans, and that's $2 million. He only paid $590 throughout his whole life. And that policy made him a ton of money throughout his entire life. And then he funded his retirement, and he's still going to leave a legacy with it, with just that one single policy. And that has power. And that's where I talk about privatized family banking systems. Imagine now throughout your life, you're starting other policies. As your income increases, you can buy more policies on yourself. You can buy them on your kids. You can buy them on your spouse. You buy them on your business partner. You can have this system of policies, and that's your private family banking system. Okay. On the legacy side, I love this. Life is more than the accumulation of money or the avoidance of taxes. It's about influence, relationships, and making a difference. It's about being fondly remembered by those whose lives we touch along the way. And I think for me, legacy is a big deal. And it's less about, oh, I want people to remember me, It's more about, if we think of how many stories do we know of families, someone dies and leaves the children, just call it $1 million. How long does that $1 million last? Almost always. One generation or less, because they get that $1 million and that money just gets spent throughout their life in some form. That's the typical model, because families aren't thinking about, they're not thinking generationally. Okay. Now we hope in real estate and stacking, passive income. We hope that you have a legacy plan available if you have family or someone to leave it to, legacy, but that there's other types of leaving a legacy. So let me show you this. This is my favorite part. Okay. How do you make it intergenerational? So the first generation has to start it. You know about it now. You have no excuses. You have to start it. You start this, and then you teach the next generation. So you ensure yourself, parents, for example, do the first generation, and then ensure your kids. Now, someone brought up about trust. Your death benefit beneficiary can be the family trust. So when I die, my family trust gets funded a lot. And you have the trust designed in such a way so it's controlled in some form. It's not just there to dip into at will for whatever. And then the trust, the kids can now use this family bank, the family trust, as the family bank. And they also have their own policies. Okay, so now they've got two places that they can be borrowing against. They're going to insure their kids. The beneficiary of the kids is the family trust. So when they pass away, it will fund the trust even larger. The trust can be buying policies now on each person that's born in that family. And so the trust now owns the policies. Remember, policy owner controls the cash value. So not only does the trust have the money that each generation has funded it with via the death benefit, it has the cash value of the policies it owns of all these grandchildren and great-grandchildren and great-great-grandchildren. And how far do you want to take it? And that is a way to just to keep it going. Intergeneration. It takes intention. It takes educating the next generation, right? You have to do it. My family's going to be uber annoyed with me because my trust is set up where I took this Becoming Your Own Banker book. I 3-hole punched it. It's in with my trust. It is a requirement for someone to have read the book in order to borrow money from the trust. And they can't borrow unless they read this book, because it's that important to me. Like, understand why we set this up and why we're doing what we're doing. And I want my kids and grandkids and great grandkids, I want them to keep it going. That's why families like the Rockefellers, they're 6 generations in and still going strong, because they have systems like this in place. They can keep going and going and going and going. And it's not beyond us, I think, well, I mean, we're no Rockefellers, right? We're no presidents, we're no big corporation owners, but it can be done. You saw what one guy can do with one single policy at 25 a year, you know? And so I'll kind of wind it down and say, I hear it all the time. I'm going to do this one day. I'll do this one day. I'll do this one day. I never met a person that said, gee, I'm so glad I waited. It's when's the second best? People say, well, I should have started this 5 years ago, 10 years ago. You should have, but when's the second best time to plant a tree? Second best time to plant a tree is today. And I promise you, I'm obviously biased. But I practiced this. I was doing this before I got into it as a career, and I'm so thankful I started that very first policy when I did, because I'd still be sitting here going, gosh, I wish I would have started something so much sooner, And I've used that one. My very first policy was $400 a month. I've used it for a ton of stuff. I mean, car loans. For me, my stepdaughter once, down payment on a rental property, and we had a big lakeside Airbnb. I've had it on, actually, I just used it again and bought a motorcycle, and I mean, just different things, whatever. It's saving me money. You can't go get a loan right now for under 6%, and so it's going to save me money, and I'm building it throughout my entire life, and I have other policies. So it's something you can use. Anyway, I'm not hard to reach. You can go to 1024wealth.com/Enria, and schedule something with me. There is a phone number and email on the screen. You can scan the QR code. It'll take you right to that site. And we'd just love to chat. I don't charge to sit and talk and educate and strategize, and it will not cost you anything. Okay. I want you to understand it, and I will help you get it implemented. You need to, if you have a buddy who's an insurance agent who doesn't know about infinite banking, please do not go in there and say, hey, I got $30,000, start me a whole life policy. I've seen it happen. They're going to structure it wrong. You're going to call me really mad. and it's done. You can't do anything about it now. Now you just spent that 30,000, your cash value is zero, and you won't see access to any of it for another year. Stuff like this. So be careful. I've gone, I'm an authorized IBC practitioner through the Nelson Nash Institute with that book, which reminds me, let me show you this if you want to get the book. And your only money out of pocket is whatever you would put into a policy, is what I'm trying to say. So let's chat. Let's see what your situation is. Let's brainstorm and see what we can do. Okay, you can get the book. You can go to the Nelson Nash Institute website, certainly, and buy the book. It's 21 bucks on there plus shipping. You can go through my website, you enter this discount code, you can get it for the book. You can get it for 17 plus whatever postage is. Okay, it's a good book. And I am done. I'm gonna put it up for questions. I see one first. Are they being regulated? Regulated by, let me clarify that question. So the IRS sets limits as to how wide that corridor needs to be between the cash value and the death benefit. In other words, because you're collateralizing the death benefit, you couldn't, if you had $1 million in death benefit, you couldn't have $1 million in cash value. Otherwise, it would be what's called a MEC, a modified endowment contract. And then the IRS, that makes that policy a taxable product. So every time you take loans above your cost basis, it's taxable, and you don't want that. So we structure them so that never happens throughout the life of the policy. So that kind of regulation occurs. Other than that, the loans are loans. The insurance companies loaning, you borrow the money against yourself, and that's it. They know you're good for it because of the death benefit. So if you never ever pay that loan back, it's just going to compound year over year over year, and eventually you're going to die, and eventually they're going to recover their money. We don't suggest that, but other
Okay,
questions?
other question, which I don't see in the chat, but, um, health of insurance company, is the insurance company insured? I've had insurance companies go bankrupt on me when I had a claim against them, so.
So they are, okay, let's talk about two things. Banks, about one insurance carrier goes insolvent to about every 600 banks collapsing, okay, for ratio. And the insurance company is insolvent. This shouldn't be an instance where they just disappear and you lose your life insurance. I've never heard of that, because the state, I mean, the insurance board, they step in and basically they sell those contracts to a different carrier, and you'll end up at a different carrier.
Okay,
That's what happens. So they don't just go away. They can't, because it's a contract, it's a life insurance contract. And so they can't. Also, life insurance companies are required to have assets equal to their liabilities in some form. So when COVID was happening and there was this mass influx of deaths, so Emeritus, we've used Emeritus on the screen here before. So Emeritus, I was talking to their actuary, and they were liquidating pretty heavy at that time, getting cash on hand and ready. But unlike banks, we talked about fractional banking, right? They don't have, that money's not there. If everybody went to the bank and wanted their money, it's not there. Life insurance, if everybody died at once, it would take them a minute, but they have it.
okay.
It's there. Good
All
question.
right. Questions from other people? Feel free to unmute and speak up.
How much to get started? How much to get started is probably the number one question I get. So again, it is about you and your situation. So that's why it's important to sit down and talk and go through your situation, look at your financials a little bit and talk. What's your income look like, and your free cash flow and your expenses? What kind of debt do you have? What are your goals and objectives? And let's move all the puzzle pieces around and look at it and come up with a plan that works for you. Like I say, I have clients doing $200 a month. I have clients doing 300,000 a year, everything in between. And it just depends on what's right for you.
Okay, quick question, Jason. You've been using this two-part. You've been using this for how many years yourself? And
About 10. Yeah, about 10.
Okay, and you've been selling it for how many years?
About 5.
Thank you.
Yep. Yep.
Okay.
Any other questions? Reach out to me. Let's get on a call. You know, we can get on Zoom or phone call if you want and chit chat, no strings attached. And just see, you know, sometimes it doesn't make sense. Sometimes we want to get you filled in enough and you find, okay, this doesn't make sense to me to do right now. Sometimes you're uninsurable and we have no other options. You know, we run into that. You know, just strictly from a life insurance standpoint, we can talk just life insurance. You know, you saw on the screen, Jane showed in the opening, you know, we do deal with like instant term products. If you need quick term insurance and stuff like that, you just having appropriate coverage is good. So we can have those conversations as well. You don't have to just call me for infinite banking.
How many policies do you have, Jason? How many do you personally have now?
Own or have?
Yes, sir. Well, own, okay,
Yeah.
own and have. Why don't you answer both? I don't know the
I've got
difference.
five. I own 5 right now.
And what is have? What's the difference between own and have?
Am I the insured or not? Because I own policies on my kids. So I have policies on them and then I have policies on me.
So you have 5 on yourself and then
I have
you
3 on myself right now, 2 on the kids. Yeah.
total of 5. Okay.
And I, you know, and they've started incrementally, you know, as I've moved along, have started other policies and I'll continue to do so. You know, because I've these policies you can't, you know, if my income goes up, I have more free cash flow and I want to start other policies to build throughout my life. And so I'll start other policies. I can't keep increasing what I already had scheduled on the old policies.
Sure. Thank you.
Yeah.
Okay. Thank you, Dick, for questions. Anybody else with questions?
I do, Miss Jane.
Hey,
Is there a limit to the amount of policies you can open?
there's not a limit as to the number of policies you can own. I know someone that owns 38 policies. That's probably the highest I've heard. But he owns them on himself, his wife, all of his kids, every grandchild that's born, he's buying a policy. Where you get limited is the total allowable death benefit on a life. And that is dictated by a lot of different factors. Mostly it's going to be like if it's on yourself, it's going to be a multiplier of your gross annual income or your net worth. And so we calculate that based on that paired with your age. And so
What
there's
is the, okay,
what's that?
thank you. What
Yeah.
is the always says you can get a life benefit in there with you? Life policy.
Say that again.
What is the age you can get a life policy with you?
Oh, I mean, you probably won't be able to get one over 75. Under that, you could get one, but the question is it cost prohibitive? You know, so that's something we have to look at. We can get them on newborns, a month old. You know,
Yeah.
we can cover the whole spectrum, you know.
Jason, if you got them on your kid,
Yeah.
could you then be using the banking function
I can, yes.
so you can borrow against the kids'
Mm-hmm.
policy?
Yep.
Okay.
Can they be restricted for using it? I don't have any kids under age.
Will they
That's my-
what?
Well, Daniel, if you own it, as I understand what Jason said earlier, if you own it, you can control the borrowing.
Right. So my kids have policies and so I can choose to borrow against that cash value and use it for however I want, as long as I'm the policy owner. What I want to be careful of is not having a big outstanding loan when I hand ownership to them. That's not a very nice gift. Give them ownership of the policy with a big fat loan on it. And so even upon the instance of death, we always want to make sure if you own it on other people, do you have enough coverage separate to fill that pot back up before they take ownership, if that makes sense.
Yeah, it makes sense, Still a lot more to learn, but
Yeah.
to look it into, but Yeah, I'm scheduling an appointment with you. You
Yep.
put it busy, but
Yep, that's great. We'll chat.
I don't mind that. Looking forward, Jason, okay?
Good deal. Yeah, I teach my kids, they're 7 and 8. So I'm teaching them at a 7 and 8-year-old level right now of just typical, they know dad teaches people about money and they know, a lot of times one of my sons, he'll sit off screen and just listen to one of these webinars just because he's curious. And he knows we can borrow. He's like, can I borrow and buy a video game? I'm like, no. No, you cannot right now. But they know, we've got it set up so like by the time they're 16, there'll be enough in there we can borrow and buy a car, and then they can pay that back over a few years. And then by the time they're in college, we'll have enough in there to pay for a year of college at least if they choose to go to college. It's kind of another thing, for kids and grandkids, instead of like 529 plans where you're kind of capped on contribution or you're capped on or limited as to what you can use it for. Even stuff like that and policies, then if they decide not to go to college, it's no big deal. You use it however you need to use it. So it's a great alternative.
Yeah, sounds like it.
Yeah, it is good though.
All right, other people with questions? Or
One,
I don't mean to leave out Daniel and Dick, but okay. Well, Jason, been informative. There are a few moments it's kind of gone, but I managed to rein it back in, at least personally.
Yeah,
Other people have too.
yep. And this is a concept, like my whole first year was just constantly learning, trying to get my head wrapped around it and using it. The more I used it, the more I understood it. The more I understood it, the more I start using it even more. And then it's one of those deals you kind of, and we'll spend as much time with anybody as needed, just getting education in place so you know what you're doing and continued education.
And I did notice on your website, you've got a ton of seminars that you've done with other people and podcast type of stuff. So
Yep.
anybody feels like they need to listen to it 2 or 3 more times before they can knowledgeably talk to you.
Yep. Yeah, there's plenty of stuff on there. Plenty of stuff on there.
All right. And thank you, Tony, for stopping the, oh, that wasn't Tony.
I did.
It
Yeah.
was you. Tony's, I think, the one in control of the recording.
I am.
All right, I'm stopping it right now. I